Walter Schloss generated 16% annualized returns for 45 years. A $10,000 invested with Walter Schloss would have been worth roughly $8 million at the end of the 45-year period. Walter Jerome Schloss was an American investor, fund manager, and philanthropist. Walter Schloss started as a runner on Wall Street in 1934. By 1940, he had taken a couple of courses taught by Ben Graham, which led to him working under the master at Graham Newman. Then, Schloss started his own partnership in 1956 after Graham Newman shut down. Not losing was also a priority. So he naturally gravitated toward Graham's value investing. He looked for low-priced stocks relative to book value with little to no debt and a long track record behind it. And it worked for 45 years. From 1956 to 2000, his limited partners earned 15.7% annually after fees versus 11.2% for the S&P 500. His was a simple strategy that got great results. Here are 15 interesting quotes on investing from Walter Schloss. 1. Timidity prompted by past failures causes investors to miss the most important bull markets. 2. As the saying goes, a stock well bought is half sold. I think Ben was an expert in that area. 3. I learned that if I can simply survive in the market, just like surviving in the war, and not lose money, eventually I will make something. 4. During the Depression, my father learned his lesson and said to me, anything terrible that doesn't happen to you is profit. I took the advice to heart, so when I entered Wall Street, my goal was not to lose money. 5. Obviously, Ben Graham was the teacher who showed me the way, but it was also my 4 years of military experience that shaped me into who I am. I learned that if I can simply survive in the market, just like surviving in the war and not lose money, eventually I will make something. 6. I think in the first place that we are honest people. We have tried to prevent our investors from losing money, and we have not tried to make money at their expense. I don't know about the others, but I am 95 years old now, and I sometimes forget what I am supposed to remember. One thing I will always remember, though, is how America has given me the opportunity to invest and the freedom to do what I enjoy doing. Being grateful for that opportunity, my goal was never just to bring value to my investors, but also to do what's right for those who trusted me. 7, because I don't like stress and prefer to avoid it, I never focus too much on market news and economic data. They always worry investors. Besides, I'm not good at market timing, so when people ask me what I think the market is doing, their guess is as good as mine. 8. The challenge in life is knowing what's next. 9. When it comes to investing, my suggestion is to first understand your strengths and weaknesses and then devise a simple strategy so that you can sleep at night. 10. Investing should be fun and challenging, not stressful and worrying. Stick with what you like to do rather than do something you don't like, but that will make you money. 11. I felt that I was a grocery store owner, holding stocks as my inventory. Sometimes these stocks paid dividends, and so they were worth the wait. Eventually, someone would come along and offer a good price for my inventory, and I would sell. 12. Many investors today focus on earnings, but I focus on assets and don't try to predict next month's earnings, which is a much more difficult approach to investing. 13. I always held 50 to 100 stocks at any given time because it would have been very stressful if one particular stock had turned against me. Psychologically, I'm just built differently than Warren Buffett. I see that there are many people trying to be like Warren, but they should take note that he is not only a good analyst, he is also a good judge of people and businesses. I know my limitations, so I'd rather invest in the way I am most comfortable with. 14. Don't be afraid to be a loner, but be sure that you are correct in your judgment. You can't be 100% certain, but try to look for weaknesses in your thinking. Buy on a scale and sell on a scale up. 15. Listen to suggestions from people you respect. This doesn't mean you have to accept them. Remember, it's your money, and generally it is harder to keep money than to make it. Once you lose a lot of money, it is hard to make it back.